Hello, welcome to the Market Carver. I am Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. So happy you gave us a few minutes of your time. I'm sure everybody's wanting to tune in here and get our week-by-week update as things progress in the market and activity continues to pick up. And we're happy to do that and share with you our insights. As always, whether they're positive or negative, we'll always give you the analysis in the world as we see it. So the three things we'll hit today are pretty straightforward. The first is in commercial property. The next is in breadth. Andrew to give a deep dive into one of the important parts of the technical analysis of the market, and then a look at the consumer and how they're shaping up in what is a challenging environment for many. But let's start with real estate. So I'll preface this by saying real estate has been very strong, whether it's residential or for most pockets of the commercial real estate world, that has been very, very strong. But it's certainly something we had to keep an eye on with interest rates going up as strong and as fast as they are. Inevitably, we were looking for some sense of a change in that. And I think we shared in this Market Carver a couple of weeks ago that mortgage applications that would be on the residential side are beginning to decline pretty rapidly. All that makes sense is just adds more emphasis that the real estate market likely to be a little soft, as you would expect from the softness we've seen in stocks and bonds. But this is commercial property sales that we're looking at and year-over-year changes. And so indeed, we're beginning to see that sector roll over. So just like all the other asset classes, beginning to see the beginnings, and yes, I did mean it to say it that way, beginning of the beginnings of the cycle in commercial real estate. So it's not a group that you want to just shun altogether, especially if we remain in an inflationary environment for longer than expected, which is completely possible. Real estate's a good way to help diversify and round out the portfolio. You just have to be very careful in what sectors and what areas you're invested in. So that's the real estate side. I want to shift over onto the equity side. So Andrew, we've seen obviously the S&P 500, which as you've told us many times was driven last year and in parts of this year by a handful of stocks. It's important for us to take a deep dive in how broadly stocks are participating on this downside.
So here recently, we've started seeing a little bit more selling. Last week, we had the market drop on Thursday, Friday. At the start of this week, again on Monday, we had some more downside in the U.S. equity market. And we've now eclipsed those prior lows that we hit in May. We had a little bit of a bounce, and now we're back making new lows. You can see it on the top panel of this chart. And we will always want to remember that the stock market truly is a market of individual stocks. And so we want to see the level of participation. Are we seeing a lot of stocks participating in the S&P trend? For the prior years, it was that uptrend. We want to see a lot of stocks going higher. And that, as Adam noted, that the trend was really being driven by just a handful of stocks. And that was a concern. We want to see a lot of stocks participating on the upside. And on the other flip side of that, when the market's going down, we want to see, are there a lot of stocks that are also going down with the market? And so we look at different time frames. How many stocks are making 52-week lows? How many are making 6-month lows, 3-month lows, 20-day lows, which is essentially about one month of trading days. And so what we're seeing there is we are continuing to find a expanding level of new lows across individual equities. With the selling that happened on Monday, we had a lot of stocks to continue to make 52-week lows, as you can see on the 52-week red portion of this chart. It eclipsed, got more than we actually saw in May. We saw about a little bit more 6-month lows, saw more 3-month lows. And so we're just continuing to see an expansion of selling. Traditionally, that's not what we want to find a durable market low. Not every market is the same, but traditionally we start seeing less stocks going down. We start seeing less new 52-week lows by the time that selling begins to become exhausted. And unfortunately, we're just not seeing that type of sign, that type of sentiment yet in the market. We are still seeing an expansion of selling. So we share the sentiment of we'd like to start seeing some bullishness. We'd like to start seeing the trend move higher. It just doesn't feel like that's in the cards quite yet. But we continue to be dynamic. We continue to watch the data and are eager to start seeing some more bullish signs that we can then respond to.
Yeah. Thank you, sir. That's exactly what we're looking for on the stock side. We will see those signs. It's just a matter of when.
Right.
And so lastly, we'll just wrap up with a take a look at the consumer. And, there's two ways to look at this data point, Andrew. One is the bullish side that investors or consumers are aggressive in spending. But I'm with you in the way you presented this yesterday. And I think it really feeds the sentiment overall in the economy, which is really negative. We know that if you basically in a survey, it's very, very negative. To me, a big reason why is that whether or not the overall economy is soon going to be in a recession or not, a good portion of the Americans, a good portion of households are certainly in a recession, given the food costs, energy, transportation, and shelter.
Yep.
It's such a big percentage of so many households that we do see a tremendous pressure. And as a result, that's at least feeding this chart of a dramatic rise in consumer debt. And that is peaking up. So I'll let you add to this because you brought this to the table Monday, but that was just my view on it as well, as it can feed some of the negative sentiment we see out there.
So with prices going higher, part of the reason that we saw the market take a dip last week was we got the latest reading on consumer price index, a way we can measure inflation. And that came in at May at 8.6%, actually the highest reading since 1981. And so with the rising cost of products, people have to spend more money. And so what we're seeing is this is a chart of revolving consumer credit. Think of your credit card. When you go to the gas station to fill up, or you go to the grocery store and you pull out that Visa, MasterCard, American Express, what have you, and you swipe that for your purchases, that's considered revolving consumer credit. And we're starting to see that increase. What's troubling about that, well, like I said, there can be a positive sign there that consumers are continuing to spend. What's concerning about it is we're actually seeing the savings rate is hitting multi-month, multi-year lows. So what those two combined tell us is consumers they're decreasing their savings and they're spending more on credit cards. And for some Americans that carrying those credit card balances, that can be very costly as they're paying interest on that. And so we're starting to see where consumers are really having to turn to what could be considered an undesirable form of debt because of those higher rates, because of the higher rate of inflation. Bloomberg came out and said that based off their data and their analysis from their economic team, that the average household is going to have to spend a little over $5,000 more per year, or for this year, to buy the same typical goods that they purchased last year. Again, that's an average, so that's looking at some very high spenders and some very low spenders. But on average, what they're saying is that the average consumer is going to spend about $400 more a month to buy the same type of stuff that they bought last year. And so that's contributing to why we're seeing more spending being put on credit cards. And should we start seeing labor markets change where maybe the employment rates going up and wages decrease, that's what can lead to what Adam was discussing about a possible recession, to where the consumers they're being stretched right now, and they eventually, if this continues, they could break. And then we start seeing spending come down, and that's what can obviously roll into slower economic growth or actual contraction.
Yeah, said much more clearly, as I would expect by you. So that is a situation that is unfolding. And the one thing that I'll just add to that, as always, is we position your investments the best we can according to this data. And so we don't always lean too hard on economic data because it's not that helpful from a forward perspective. However, we're certainly seeing this impact certain segments of the economy different than the others. So certainly some more discretionary areas of the consumer. Those stocks have been hit hard, but there's others that are benefiting from this. And it's really our job, and something we do on your behalf each and every day, is using that to align and position the best sectors that we possibly can, and not just taking what the overall market gives us. So hey. Those are just a couple extra additional thoughts, and we do appreciate you giving us a few minutes of your time and spending this with us. Don't forget that you can give us a call to schedule your complimentary meeting, 800-928-4001. And as always, don't forget the weekly radio show over the airwaves on WIBC or through podcast, however you happen to get yours. So thanks again, and have a great weekend.